Hey everyone, Jim Fitzpatrick. Joining us on CBT Now is Mr. Alan Haig, who's president and founder of Haig Partners, to take a closer look at the changing landscape of dealership values. So thank you so much, Alan, for joining us once again on the show. Really appreciate it. So what's this whole talk about changing values? Makes us nervous.
Well, it's an interesting time for those of us in the buy-sell world. We've had an incredible 2.5 years from when the pandemic hit until now.
Yeah.
Dating back to 2019, it was pretty easy to determine the value of a dealership in 2019 because profits have been so steady for the previous 5 to 8 years.
Sure.
A lot of buyers assumed that 2020 would look like 2019.
Right.
And then when the pandemic hit, M&A went to zero because buyers got spooked. They weren't sure what was going to happen.
Yeah.
Sellers didn't want to sell, unless they got a fair value. And then when dealers were able to sell and service cars again, profits just started taking off.
Mm-hmm.
And so we saw a lot of M&A happen in the second half of 2020. And then 2021 was just the most active year ever in our industry, probably by double.
Really?
And
double.
we saw,
wow. That's incredible.
Yeah, we saw over 700 rooftops trade hands last year.
Mm.
And this year has also been very active. We haven't seen some of the giant deals from the public companies like we saw last year.
Mm-hmm.
But in terms of the number of rooftops sold so far, it's technically ahead of the pace of last year. More private dealers buying private dealers than the publics.
Okay.
So M&A activity is pretty broadly spread around the country. But the valuation of stores has become more difficult because no one knows what a store is going to make next year.
Right.
Profits more than tripled from 2019 to the first half of 2022. If you look back 12 months, July to June of 22.
Yep.
So that's fantastic. But I think all dealers recognize that at some point margins will begin to come back down towards earth. Right now, they're up in the stratosphere.
Yeah.
And also dealers are expecting that their costs are going to go up a little bit because of higher interest rates.
Mm-hmm. Mm-hmm.
So we're seeing, we're sort of tracking how valuations are coming in compared to what we thought they would be. And we regularly give clients or potential clients an estimated value for goodwill, assets, real estate before they engage us
to
make sure that if we go to market, what we expect to get is going to be motivating and exciting to them.
Right.
So we don't, go to market and not get good offers. That's a bad outcome for the clients, a bad outcome for us. It's a bad outcome for the bidders. They've wasted their time.
That's right. That's right.
So we went back and looked about a month ago at, how accurate have our estimates been. And in 2019, we basically were dead on. The range of value that we set forth, we had a high and a low for goodwill.
Mm-hmm.
We were at 98% of the midpoint of our range for all of our clients that closed in 2019 compared to the estimates we gave them. 2020, we didn't anticipate the pandemic when we were giving our estimates, right? So the offers our clients accepted were at 86% of the midpoint of our range.
Mm-hmm. They
were concerned, buyers were concerned. We weren't sure what the future was going to be like. So the offers that they accepted were below the midpoint of our range.
Mm-hmm.
And then as profits took off, the market was running faster than we could keep up. So in 2021, the average offer that our clients accepted was 106% of the midpoint of our range.
Wow.
6% over. So basically at the top of our range because we have about a 10% spread.
Okay.
In 2022, for the offers that we've closed on, the offers are 119% of the midpoint of our range.
Wow.
So way over the top of our range.
Yeah.
And in deals that haven't yet closed, but we've accepted the offers or pending manufacturer approval, the offers are 33% above the midpoint of our range.
My gosh, that's great.
That's great. So we've been kind of, estimating values, looking a little bit in the rearview mirror, but anticipating some decline.
Sure.
But now that we're seeing the rising interest rates, the inventory starting to come back a little bit with some franchises. Like we have a dealer friend that's got a Nissan store, 2 of them actually. He's selling back at invoice on Nissan now. It shocked us. We have other dealer friends that have Mercedes stores that still have a $50,000 addendum on a G wagon. So they're still getting over sticker in some of these franchises.
Yeah.
But so now we're anticipating that our our formula, how we're valuing stores, probably needs to change again. I think a lot of buyers had given up even paying attention to 2019 when they were formulating their offers. It's our belief that they're going to have to factor in some caution.
Mm-hmm.
And also, the interest rates are going up for the buyers also.
Wow.
So
yeah.
I talked to a banker friend of mine, and he said he's seeing two things in his practice right now where some buyers are saying, I'm not totally comfortable taking on debt that has a floating interest rate. So I might want to just wait and see before I buy stores to see where that rate settles out.
Okay.
I don't want to, take on debt that's at 7% and it goes to 12%, for instance.
Right.
And other clients of his are saying, I'm still going to do this deal. I'm just not going to borrow any money from the bank to do it.
Yeah.
They've got so much cash on their personal and corporate balance sheets that in many cases, they don't need any financing to do acquisitions.
Right.
So I think for us, what we take away from this is when there's this significant amounts of instability, went way up. Now we might have a recession. I don't think dealers are going to suffer as much in a recession as other businesses.
Right.
Because there's so much pent-up demand.
Yeah.
We believe margins are going to remain elevated.
Mm-hmm.
But we can't ignore that, this giant lift in valuations will be with us forever.
Mm-hmm.
And so as buyers become a little bit more cautious about the future, our belief is that valuations are going to slightly come down in the second half of this year from where they were in the front half of this year.
The second half of 2022.
Yeah. So we're now in the fourth quarter, right?
Yeah.
So we're starting to see it a little bit.
Okay.
But not a lot. I mean,
and it's probably franchise specific, right? I mean, people still want Toyota stores. We'll pay crazy numbers for a Toyota store, right? Maybe a Benz store, things like that. But
yeah, I mean, we just were involved in the sale of the John Elway Crown Toyota store. It's been maybe a month and a half now, 2 months.
Which was like one of the largest Toyota deals, right?
It was the second largest Toyota deal. And I think it was the second largest deal of any franchise.
Wow.
Toyota stores have become so profitable.
Yeah.
I think many dealers have become convinced that Toyota may be the best partner for them.
It really is. It's a phenomenal OEM to work with.
Yes. So it may not be their highest return on investment when they spend a lot for a Toyota store.
Sure.
But it has a lot of security built into it.
Yeah.
And that matters to people. If I can invest something and it's safer, I'm willing to get a lower return on investment than taking a flyer on a franchise that's a little bit scary to sound to some dealers today.
Sure. There's no question about it. Hey, let me ask you, changing gears a little bit, Ford came out last month I guess about a month ago and said, hey, you've got to, for a Ford dealer, you've got to meet these 5 pillars in order to sell our EV lineup of vehicles. If not, you have another opportunity down the road. But for those dealers that are willing to make that commitment, that, $900,000 to $1.2 million commitment on chargers and such, you will be able to sell our EVs. Did that get your phone ringing at all for either buyers or sellers? I can imagine if I'm looking to pick up Ford stores, I might give you a call and say, hey, who do you know that doesn't want to make that jump, that we'd love to get their store and start, make the investment and start selling EVs. And then on the other side, I would imagine there's Ford stores that say, I'm out. I don't want to make the jump. And I don't, maybe this is a good time for me to exit the whole deal.
We haven't heard somebody say, I want to get out because of this charger.
Okay.
Although it's pretty new news, Jim, right? They just released that a couple of weeks ago.
Right.
We have seen some buyers say, ooh, that's an incremental investment.
Yeah.
I hadn't factored in my analysis. I need to think about this.
Yeah.
So we are seeing some transactions where the buyer is just kind of taking a pause and trying to figure out, what does this really mean for my return going forward? I think that Ford is this is a personal hunch, Jim, that Ford's belief that they're going to be able to take orders for EVs online and satisfy the consumer is going to change. Because if I'm a customer and I want an EV and I go to my Ford store and they have a Mach-E that I can drive, but I have to order it and wait several weeks or several months for it to be delivered.
Right.
And I go down the street to the Hyundai store and they've got an Ioniq 6 in stock that I can take home today. I go to the Kia store, they've got an EV6 that's in stock and I can take home today.
Right.
I go to the Toyota store and they've got an EV that's in stock and I take it home today.
Or the Toyota guy talks you out of an EV altogether and says you
better take a hybrid. Yeah.
You need a hybrid. Okay. But
I
yes,
think
any one of those scenarios.
I think Ford loses share. And I think the dealers started to say, what is the benefit to the consumer by making them wait? Why shouldn't we have an inventory here on the ground? That's the way we've always sold vehicles in this country. It's been very profitable for the manufacturer. It's been very profitable for the dealer and convenient for the customer.
Yeah.
So my sense is that Ford revises their plan and that they retail these vehicles conventionally. But that's to be determined. That's months or years in the future.
Right.
But I also think that most dealers that are acquiring stores today know that every factory is requiring has already required an investment in charging infrastructure. Right. Every brand's got to have customer-facing chargers and chargers in their service drive.
Sure.
They want to be in business. Ford's just being a little bit more dramatic about it, and the requirements for pickup and delivery.
And I think also the standardized pricing, OEMs, they got their cage rattled here in the last couple of years to see that cars are being sold on showroom floors for $50,000 over MSRP. It bothered them. They're like, wait a minute, we could make more money on these vehicles than what we're selling them to the dealer for, or they're selling it to the consumer for. We want a piece of that. But at the same time, it's also ruffling the feathers of those loyal consumers of that brand that then write an email to Mercedes-Benz or whoever to say, hey, you got to be kidding me. I've been driving this, a Lexus for the last 25 years. Now all of a sudden there's a shortage of them, and I got to pay $25,000 or $40,000 over sticker to get one. And it doesn't sit well with OEMs. I've spoken to a number of OEM executives on this topic, and they say off the record, this is not good for the industry. It's not good for the consumers. It's not good for us as a brand, because we can't control that. And yet the consumer's getting mad at us going, oh my God, how come I'm buying these Fords or whatever the brand is that's getting charged over? And we want to hold on to that customer just as much as the dealer does, but the dealer wants to make the money right now on that car and not sell it for MSRP, but sell it for 20 over, 10 over, 5, whatever the number is. It's always usually relative to the demand of the car and also the sale price, right?
Yeah, I think this is a temporary issue that is upsetting customers and OEMs, but I'm smiling because the OEMs have significantly increased their sticker prices.
Right.
Take this margin away from the dealers.
Yeah.
So they're not trying to reduce costs to the customer.
Right.
And I am sympathetic with dealers who say, hey, for years I sold cars at $800 over invoice or $1,000 over invoice, or
way under
invoice.
Right.
Yeah.
I was going to say, yeah.
And if I sold cars just at sticker, my customers could come in, buy the vehicle from me, and flip it for several $1,000s or more in profit. Why is that fair? I've been investing.
I go back and forth on this issue. It's I think a dealer, though, in my humble opinion. So dealers, please don't write me an email because you know how I feel about this. I think when they say it's all about the customer and it's all about the integrity of that store and it's all about building a good culture with inside of a dealership, and then all of a sudden there's a shortage of cars and the dealer goes, oh yeah, take all those MSRPs and mark them up 10 grand. Okay, and you're like, wait a minute, what happened to that whole we're taking care of the customer before, during, after the sale? We want to sell that customer every car in the house, not just this one. We've heard it all before. I worked at all those stores. I ran those stores. That was the pitch. And now all of a sudden when the dealer has the opportunity to put the noose around the customer's neck, they do it. And then they go, wow, how come everybody's getting upset? Well, come on, man. The guy's been buying cars from you for the last 25 years and has bought every car in the house. And now all of a sudden comes the time, only to your point, because every dealer's told me that same thing. Well, they're going to go sell the car on the open market. Let them do that. If they want to become a dealer with one car or two, that's up to them. But in my humble opinion, it shouldn't change the integrity of the dealership and their long-term goals in the marketplace for those consumers and also for those salespeople and that staff running the dealership. I don't mean to go off here, but it does change the mentality of the team inside that says, on Friday, we were all about taking good care of the customers for a long-term basis. And on Monday, we're slipping the noose over their neck and charging $20,000 over sticker price for the car.
Yeah.
Again, just my humble opinion, I think that's very, very problematic. And I think we're seeing that when Ford says, oh, by the way, the number one pillar on this, standardized pricing. We're not going to tolerate, somebody that comes in and goes, oh, you can't get the Mach-E? Yeah, at 15 grand, it's going to cost you more. So that's why I think you see OEMs wanting to get more Tesla-like and saying, we're going to control that pricing directly from the factory, and we'll have it drop shipped to that dealership of your choice. And I think we somehow did this to ourselves in the industry in a grander picture. But again, my humble opinion, I'm not a car dealer. So
I could see a world in which, there's one price, right? There's a price stated by a dealer. And in some ways that would simplify the life of the dealer. Say they get vilified because they negotiate. But hey, if it's just one price, if it's like Tiffany's, we just charge a price, their lives would be significantly simplified. They wouldn't
there's
need
no question.
sales managers. They wouldn't need salespeople.
That's right.
They would have product demonstrators, and compensation would come down, and advertising would come down, and floor plan would come down.
Right. It's got a lot of benefits. A lot of benefits to it to get that pricing standardized.
So I think, for us, we're not afraid of changes in the dealership model because it's so flexible, right?
Yeah.
If the new volume drops, dealers can charge more.
Yeah.
And there are different ways to charge more. There's always the trade allocation, right? And there's F&I, and then there's parts and service. And dealers have done an incredible job in this pandemic. We talk about the vehicle gross margins that have gone up. What about the fixed operations?
I know.
I think they're up 17% over last year, with fewer units in operation.
That's right. That's right. Well, you think about people that are now keeping their cars longer. What happens? They're putting more money into them. They don't have a problem with the $2,500 repair bill. Yeah.
I've got a 6-year-old BMW now. I would have traded it years ago, or handed it back in. Now I'm getting these readings about my emergency call system is down, so I'm taking it into the dealer to get it serviced, versus the next guy might not have done that if it gone into the secondary market.
That's right. That's right.
So I think, these times, Jim, getting back to M&A for a moment, because the future is a little hard to predict.
Yeah.
In our opinion, it's more important than ever to let the market speak, rather than us predict what the values are. What we've discovered is that, in most cases, running a process where you're involving multiple buyers, everybody gets the same information, a comprehensive book that describes what they need to know to make an offer. They're in the same process. A client of ours is going to get a set of offers. Typically, we go out to maybe 8 or 10 of the most likely buyers.
Okay.
We want to get at least 3 bona fide offers.
Yeah.
But sometimes the range of offers now is significant.
Oh, I would imagine.
We're working on a transaction now where the first offer in terms of goodwill is almost 50% higher than the next offer.
Wow.
That buyer sees a lot of value in that business. Sometimes it's, hey, it's in my backyard.
Yeah.
Sometimes it's a franchise I really want.
I was going to say, sometimes it's just the ego of that dealer that goes, I've got the whole, I just need the ace of spades here. I just need to complete this deck. So I want to put that in my portfolio so I can clearly say, oh, we sell every brand of car out there. So it depends on how bad they want that, right? And
that's
conversely,
exactly right.
The seller might say, I have 3 Toyota stores. I'm good. So I'll take a deal on this one to let it loose, right?
Yeah, that's exactly right. As everybody has a different acquisition strategy.
Yeah.
So for some people, they wanted to get into new markets.
Yeah.
They'll put more value on a store in the other guy's market than they would in their own, for instance.
That's right. That's right.
Other people want to defend their turf. Like we're selling a Lincoln dealership now, and the offer we got was from Ford dealers who wanted to protect their turf on wholesale parts.
Wholesale parts. That's great. That's an angle.
Move. Yeah.
That's
interesting.
And
the value was a good bit higher than what the client was expecting. So they're happy, and the buyer is going to have now another revenue stream that they didn't have.
Hence the reason your broker, in this case, Haig Partners, needs to develop those 3 or 4 different offers, right? Rather than bringing you one and going, okay, we decided this is the best one for you. You got to work those guys against one another, right?
That's exactly right.
Yeah.
Years ago, I headed up the corporate development, the M&A team for AutoNation.
Right.
And when I was talking with a potential seller, my favorite position to be in was when I was the only person talking, only buyer talking to that seller.
That's right.
Because my offer was setting the market.
Yep.
didn't have anything to compare it to.
That's right.
But when we go out and we bring back 3 or 4, you
That's
know,
right.
and dealers know that it's competitive, they've got to put forth their best offer. And it's a way to allocate the dealerships to those who want them the most.
That's right.
You know, you can still have a confidential process, but it's particularly today when the values are kind of hard to determine, and the get big or get out strategy is increasingly prevalent. You know, sometimes the best buyer is down the street. Sometimes he's thousands of miles away. You know, Jeff Swicker, the buyer there of the Crown Toyota, is a good example. He didn't have any dealerships in Southern California. This was his first major investment, and I'm sure he'll have more in Southern California. Yeah. But you know, Mitch Pierce, John Elway, they weren't aware that he was
you wouldn't
be the
think
best buyer for that business.
That's right. That's right.
So that's what's fun for us, is we have a good idea of what we think is going to happen, you know, with that estimate of value.
Mm-hmm.
But until we get into the market and really talk to people and understand their strategies and their motivations, we're not sure who the best buyer is going to be in almost any of our engagements.
On that Elway deal, did you do the end zone dance at that closing?
You know, I'm sorry, John came to the negotiation session that we had out there with Jeff and Mitch and the other guys. But the day of closing, I think he was preparing for an NFL game, so he had some other priorities.
Imagine that.
Yeah, I would have spiked the football if I could have, but there was none in the office.
And nobody to find you, right? So that's pretty good.
Yeah.
Well, Alan Haig, president and founder of Haig Partners, thank you once again for joining us on the show. It's always great catching up with you and listening to what's happening. I know you have your ear to the ground of all things, broker for car dealers that are out there that are wanting to sell or buy. And so I know that, in fact, one of your, this segment is always very heavily viewed because those dealers are, at lunch outside the dealership or watching on their laptop. What's Alan got to say about the market? You don't want to do that in the showroom, right? But nevertheless, thanks so much for joining us. Really appreciate it.
Yeah, it's my pleasure, Jim.
Yep.
Talk to you soon.
All right, take care.